going to start first of all with Tom here from MSCI, and then Nick from Avison Jung, and then we're going to use that as fuel for conversation for the panel. And of course, it's designed to be an open session. So if you've got questions, comments, please do bring those in, and we'll aim to answer those, or maybe talk a little bit about some of the concerns that you've got as well. But let's start with you, Tom. Over to you to kick us off.
Cheers. Okay, good afternoon, everyone. Hope you're all well, and last night's hangovers are wearing off. So my name's Tom Leahy. I am head of EMEA Real Assets Research at MSCI Real Assets. I joined the business last year through the acquisition of another business called Real Capital Analytics, and we're the #1 provider of real estate transaction data globally. So anywhere a deal happens, it goes into our system. And the presentation today, I'm going to be talking you through what's happening in terms of capital flows. That's money going into real estate globally, and all that data is built from our own database from the deal level upwards. So first of all, to set the scene, and I think we were all aware of this, property has been, the post-GFC property boom has been afloat on a sea of cheap money, really. So we've had period of exceptionally loose monetary policy, and so the gap between real estate yields and 10-year government bonds, the risk-free rate, has been elevated really since about 2009-10 onwards. Obviously, the world has changed substantially in the last 9 months. We've had rising inflation on the back of supply chain constraints coming out of COVID, and also higher energy costs because of Russia's invasion of Ukraine. So higher inflation, higher interest rates, and that's really squeezing that yield gap down to the lowest level it's been for a long time. So that's serving to make real estate look structurally less attractive than it has done previously. So we're in a changing market, and investors are worried as well. So this is survey data I purloined from our friends at INREV, the Organisation for Unlisted Real Estate Vehicles in Europe, and they asked their members, how confident are you feeling about the market? And you can see quite clearly everyone's worried at the moment. So everyone is seeing an increase in risk as of the latest survey that was released earlier this month, or earlier last month. And I think the other point to make is how quick has the turnaround been? So this time last year, people were pretty sanguine about the outlook for the market. That has changed completely. The other thing to say is they're also less confident about allocating capital to European real estate as well. So if you look at the chart, you see September last year, people were happy allocating, or even more confident allocating capital to Europe. Now they're less confident because of the headwinds the market's facing. So not a solid outlook, I think you'd say. There's lots of worries, lots of things to keep us up at night. But actually, if you look at the progress of the commercial real estate investment market globally, and this is the whole market, transaction volumes this year, it's a cumulative total, so through to the end of September, compared to prior years. You can actually see for most of this year, we've been well ahead of prior years. So a lot of money is still going into real estate. So the transaction volumes really have boomed, especially in the United States, and I'll talk about that in a minute. But they have started to level off. And you can see that actually coming through September, traditionally quite a busy period for deal making. At the moment, it looks slower. And so you can see those prior years catching up. So perhaps that's an early indication of a slowdown underway. If we look in more detail at these figures, so we split the global market into Americas, EMEA, and Asia Pac. And I've got the transaction volumes, quarterly transactions from this time last year through to Q3 2022. You can see it's slowing down. So we had a very, very busy period at the end of last year. Lots and lots of money was being spent. It was the best year ever for property investment globally last year. Number of properties and volumes, that's starting to slow now. And so you can see Q3 looks pretty slow. Again, if we look at the country-by-country data, I've got the US split out here because it's such a large market, it distorts the scale of the rest. And I think the point to make is, hopefully you can see those orange lines by and large, or the orange box on the chart are by and large ahead of where we were this time last year. But the Q3, the blue blocks do look slower. The exception here is Germany, where the slowdown in Germany really started to take hold earlier in the year on the back of concerns about German exposure to Russian energy supplies and what that's going to do to economic growth here. So we've got a slowing market, and I think one of the reasons for that is obviously higher interest rates, and that's feeding through to higher cost of capital. So this is a rough back-of-the-envelope calculation looking at cost of capital, which is the blue blocks, versus transaction yields. And so throughout the majority of the cycle, we've had a positive gap between where property yields are and how much it costs to borrow on real estate. And this time last year, there was a substantial gap, as you can see. All-in cost of capital for office investment in the German A cities is around 1%. Now that's increased substantially. 5-year swap rates have grown remarkably in the last couple of months, especially in the UK on the back of some dodgy politics from our new Prime Minister and Chancellor. So UK swap rates now at 5%. So that's clearly having a dampening impact on property investment. You know, if you're borrowing at 5.5%, 6%, and the yields are at 3.5%, 4%, you know, it doesn't seem to make much sense. And so that's feeding through into the transaction yields. And I mean, this is valuation-based data from MSCI's UK monthly index. Especially, you can see hopefully down at the bottom there, industrial yields starting to tick up from a record low point in the UK. This is valuation-based data, so this is lagging what's actually happening in the market. Speaking to people here, talking about 50 to 100 basis points added onto yields versus this time last year. So yields moving out, and that's obviously, and the lower levels of capital growth are feeding through into the total returns. So this is actually data through to the end of June from MSCI's global index. Total returns have started to moderate, and I think the direction of travel is illustrative here. So we haven't got the third quarter's data yet, but I imagine we'll see total returns compress even more. So that's really being driven by the capital growth segment. So total returns being driven down, or remaining positive, but not as positive as they were. And you can look at the split here in terms of the property types. Industrial and apartment remain the outperformers, but again, total returns are compressing. Notably, you can see how low total returns have been in the office sector. I think that's because of worries affecting the sector, shift to hybrid working, etc. And then if my last slide before, I'm not sure we can see that, can we? Okay, well, that was my last slide. I'm going to ignore this one. So yes, broadly, I think it's a moderating picture on the back of all these worries affecting the market. So we're seeing yields start to move up, and that's compressing total returns. So I'm going to hand over to Nick. Nick, all yours.
Thank you. Thank you, Tom. Thank you, Richard. Good morning, everybody. So I'm going to build on what Tom said and try and look ahead a little bit, because the problem is that we work in real estate, and Tom and the excellent data that RCA and MSCI put together, their data lags the market, and the real estate market tends to actually lag a lot of the other markets that we're seeing. And I think that we've got some huge pressures coming through on the market, and we've got a pretty clear indication of the direction of travel for real estate. The magnitude and the timing a bit more difficult, but I'm going to try and give you some views. As Tom said, the real estate market has been incredibly active, particularly driven globally by the US, but it's quite interesting. If you put the US and the UK transaction volumes next to each other on different scales, but the correlations are extraordinarily high. In the capital markets, the real estate investment market, what drives the markets is the flows of money around the world. The picture tends to be very, very similar when you look at the overall pattern. Now, really at the moment, what we see is a combination of three things coming through and impacting real estate at the same time, but at different speeds and ways: inflation, interest rates, and the real economy. And the outlook and the situation for all of those is changing very dramatically. Let's start with inflation, where that kicked off. We had a lot of people saying, this is a great time to buy real estate, isn't it? Because real estate's a fantastic hedge against inflation. That's what you want to be into. Well, no one's really looked at this particularly closely for about the last 30 years because we haven't had any inflation. So we went back and had a look at the numbers, redid a load of the analysis. And the truth is that certainly in terms of a short-term hedge, no, real estate isn't a good hedge against inflation. If you look at the correlations with real estate total returns around the world, they are close to zero or in some cases negative. And that's for a variety of reasons, not least because of the different types of inflation that we get. And a lot of the inflation that we've got at the moment is cost push inflation rather than demand pull. Demand pull we're seeing a lot of in the US. That's why the Fed's being so aggressive on interest rates. But here we're seeing a lot of cost push inflation, and that's not really good for anybody, and it's not good for real estate demand. And the truth is, if you do the same correlations between real estate returns and real GDP growth, they're much stronger. It's not the whole story, but the truth is the economy drives occupier demand. That's what drives rents. That's what drives investor sentiment and cap rates and yields and therefore returns. So it's really all about the economy. And that's where we come to looking at what's happening with interest rates, because clearly we're getting a huge pressure coming through on the market from interest rates. Does that mean that inflation isn't important to real estate and it doesn't provide any protection? Well, no, that's not the case. If you, rather than looking at 1 year correlations, if you look at rolling 5 years, actually the correlation goes up. If you think of this as a hold period for real estate, you look at the correlation over 10 years and it gets stronger, go all the way out to 17 years and the correlation's really strong. So what that says is that real estate from a capital value point of view can provide inflation protection, but over the long term. So what we expect to see is, if people are scared about inflation coming back, that we're going to see more of the sort of money that's looking for that capital value protection, private wealth, private money, Asian money coming in. Tom referenced what's happened to bond yields. This is, notwithstanding the great skills that everybody has in asset management and stock selection, this is the gravy train that real estate has been riding for the last 40 years, the long downward trend in interest rates and in government bond yields that's come about as a result of the taming of inflation and various other factors. And you can see that that's what's now starting to reverse. And to cut a long story short, if you look at what's going on in the financial markets, there is, the relationship between real estate yields and the risk-free rate, 10-year gilts, is absolutely there. It's really interesting to look at the relationship between real estate yields and the BBB corporate bond yield, because that actually is how the financial markets are seeing the creditworthiness of the tenants that typically make up a good institutional portfolio, typical BBB. And if you look at the correlation between real estate yields and BBBs in the UK, if you build in about a 9-month lag, that correlation is very strong, and we see that right the way around the world. We see it in the US, we see it elsewhere across Europe, and that makes sense. This is the ability of our tenants to pay rent. And so as we look at the sort of financial indicators that Tom was talking about, we can see, look at what's happened to risk-free rates, look at what's happened to the 10-year corporate bond, look at 10-year corporate bonds. In Europe and the UK, they've moved out over 300 basis points. European BBB corporate bond yields are now over 5%. In the UK, they're over 7%. Compare that, clearly there's inflation risk there that hits a fixed income asset like a bond, but the opportunities to actively manage and manage up income, which is what are the attractions of real estate, is going to be very difficult in the years ahead. So we think that there is significant pricing pressure coming through. If the discussions that we're having and what we're seeing in the market confirms that absolutely we're seeing a significant impact coming through on pricing. That could well end up being an impact of 15 to 20% on capital values. That will be very uneven. We expect prime real estate to hold its value much better. Secondary, particularly assets that need active management, that need money putting in, the funding costs that Tom's already talked about are not only high, but getting funding, particularly for construction and having any certainty around what those costs are, is very difficult. And that makes making those value-add investments very difficult to price, and therefore that's the area of the market that we do expect to see a significant impact coming through on pricing. The other point that Tom made is that we're also going to see an impact on volumes. And that's what we're seeing right now. A lot of investors just saying we're going to sit on our hands until we think the market has corrected appropriately. A lot of holders of real estate not wanting to sell into the current market. And it's interesting that statistically, not only is there a close correlation between BBBs and yields, there is a strong inverse correlation, and we see this right the way around the world, between BBBs and investment volumes. So we expect to see the market slowing. It's going to feel particularly slow, bearing in mind how strong the transaction market has been, but particularly what we're going to see over the next 6 to 9 months is the transitioning of capital, with the types of capital that is comfortable operating at these sorts of financial levels, particularly people who don't need leverage, or people who are looking for long-term capital protection, people who see the opportunity here to step in and pick up assets that are going to hit the market as some investors are forced to cycle through. So watch Far Eastern capital, Middle Eastern capital, and private wealth from around the world, plus private real estate, private money coming out of the US to take advantage of currency weakness over here in Europe. With that, Richard, back to you.
Why don't you grab a seat over there, Nick? And speakers, if you could come up, that would be great.
Oh, sorry, Tom.
Grab a seat with the microphone. And Tom, yes, you bring your microphone with you, and then we'll be in the right order. Thanks. Really, really interesting, I think, to get those two different perspectives. Really interesting also to see some of those figures that I hadn't seen, those comparisons, and actually really interesting, I think, Nick. Let's start with brief introductions. I think we know you, Nick, and we know you, Tom, by now, but let's start with you, Stephen, and then we'll just run our way along. Stephen.
Thank you, Richard. Stephen Miles, Schroders, FTSE listed asset manager, 800 billion AUM, about 10% in private assets, and about 40% of that in real estate. We've got a platform across Europe, about 200 people, and we cover all sectors, but with strengths in certain areas where we think we have a USP, such as hospitality.
Okay, perfect. Kathrin.
Thanks, Stephen. Kathrin Jung, Universal Investment. Universal Investment is the German market leader among the capital service management companies. We offer a real estate platform for all institutional investors seeking for regulatory security and efficiency. And I think we have now 32 billion assets under administration, globally covering global markets. So with a significant presence, of course, in Germany and Europe, but also in the US and in Asia.
Great, thanks very much. Ryan.
Good afternoon, everyone. Ryan Brimfield, I'm a partner at RSM. RSM is a global advisory firm offering a full suite of services to real estate clients, particular focus on corporate finance, tax, accounting, and other consultancy. On a personal level, I'm a tax partner, so our new Prime Minister and Chancellor have been keeping us very occupied over the last week or so, assuming they're still Prime Minister after the end of the day.
Well, I think it is Liz Truss's speech at the Conservative Party conference. So for those watching complete chaos, do feel free to watch that. Good. Let's start just with, huge changes obviously in the market since 2021. There we were concerned about the fact that we were all wearing masks at Expo Real if we were here. Completely different set of challenges in a way now. So Stephen, maybe just from your point of view, how do you characterize the changes that we've seen? What's that doing to sentiment, I suppose, as well? What are you seeing in the market?
It's a broad question. Last year everything looked fine, right? We had COVID, but we were learning to live with it. I think, there was money available to invest, and the markets looked relatively strong, certainly from a, broadly speaking, an occupancy perspective. This year we started to talk about inflation and some of the nervousness around interest rates beginning of the year. That's really kicked in. Sentiment, I think that there's caution. I think that real estate still seems I think a lot of capital is underweight real estate generally, so I think there's still a broad positive sentiment, but with a thick wrapper of caution right now. Just seeing how some of this plays out. Pricing, everybody expects to shift, and I think if you listen to some of the brokers and some of the transactions that are going on, certainly bidding around any sales process is reflecting the fact that sentiment has shifted.
And thanks, Stephen. And Kathrin, are you seeing a sort of pause whilst people try to work out what's happening in the market because there's still too much uncertainty? Or are you already beginning to see some of the things that Nick was saying, that we may see US investors, that there's going to be more equity coming, more of the sort of I suppose high net worth, private money? What are you seeing at the moment?
It's really a country by country analysis, I would think. So it's well, I think in Europe there's still a situation with a lot of uncertainty, clearly, but at the same time, I mean, it's one of the most established markets ever since. So we just have done an investor survey, and the outcome of the survey was that still 9 of 10 investors would, maintain their real estate exposure or would even, intend to expand it. But we see, that the let's say the dominance of German or European markets, comparably goes down, and that there's a tendency towards the US and maybe even to Asia. First of all, to the US, and I guess it's quite simple. I mean, if you have a 3-yield investment in Germany right now, or a 3-yield investment in the US, you would probably go where there is less uncertainty. So, tendency-wise, yeah, I would agree that people are looking for a special situation, and they probably differentiate more where to go and where to bring the capital.
Okay, good. And Ryan, you're obviously seeing it from a slightly different position as a consultant, seeing the transactions coming through. I suppose, have you seen transactions being pulled? What's the situation there? But also, I guess, are transactions therefore taking longer because there's significantly more due diligence? Is that creating more friction in the market? What are you seeing?
It was interesting when Tom said that they're starting to see a slowdown. I mean, from our perspective, we're not yet. Okay. But equally, real estate was quite slow to come back after the pandemic started. I expect that we will see a slowdown in transactions, as Tom's indicated, over the next 6 to 9 months. There is an element of nervousness coming through and a pause for concern. But equally, just expanding on some of the other points, I think investors and tenants are still trying to bottom out what's going to happen with people movement. So particularly with RSM, for example, we're trying to encourage people back into offices. How is that going to impact, tenancy rates going forward? Are serviced office groups going to be the thing rather than having wholesale office space?
Okay, good. I'm going to come to some of those sectors in a minute, because I think it's interesting to see what capital is going to be looking at, whether there's a comparison between some that are less interesting and others that are more interesting. Stephen, just in terms of the rising cost of debt, I suppose, what are the implications for that? I mean, does it mean we're going to have a repricing, and is that against all assets? What's your sense of that?
Short answer, yes. I think, there's, this is a great window of opportunity for equity-heavy investors. I think that's the first thing. So I think, there's been a lot of virtually free money around, driving yields down in the market. I think we're definitely over a period of free money. I'm still not sure the economy is strong enough generally to withstand interest rates where they are, or anecdotally where I'm hearing they are today. I still think the economy needs cheap money, but it won't go back to where it was, which I think we won't see yields perhaps as we went from 21, 22, that was really probably what we call a cyclical peak now. I think that's pretty evident. But there will be impact on pricing. I think, look, the immediate impact is dramatic. I think that, it's almost binary. There isn't much debt available, and what is available is expensive, and that filters through to your total returns if you're a leveraged buyer. I think if you can, almost talking to some capital investors, we're looking at how you might reconstruct that yield, and what might medium-term rates be, then a margin, and then a premium for real estate. And I think that that probably means that yields will be higher than they have been.
Okay, good.
But I don't have a crystal ball, so I'm not going to give you a number. But I think that going forward, it's just going to be higher. I think it's inevitable.
Okay, good. And Tom, I was wondering whether or not there's any sort of, whether you've got, looking at data from before, whether or not Kathrin there mentioned different geographies. We've mentioned a little bit about the different pools of capital that may be looking at that. Whilst Europe is obviously in this position, and obviously the war in Ukraine is mainly affecting Europe, does that mean this is a much more positive time for Asia, for example, North America. How do you see that sort of, whether people are looking at Europe negatively because of the proximity to what's happening in Ukraine?
Yeah, I mean, I think Europe is certainly looking a more uncertain place than it was 12 months ago in comparison with the rest of the world, purely for geopolitical reasons, and that impacts what real estate investors are doing because real estate's a long-term play. So to that extent, I think the US looks a little more stable at the moment, certainly, but the market there is still correcting. So we're still seeing higher interest rates there, higher cost of debt, and the US market's sensitive to the cost of capital. And so there's a speaking to our US colleagues and looking at the latest transaction volume numbers for the US, they're seeing a slowdown there too. I mean, I was speaking to someone down in Australia last week, and it's a similar situation there. There's still a correction underway in Australia now. They're less exposed to some of the geopolitical risks that we have here and some of the issues with energy costs, but interest rates are still rising in Australia, and they're still seeing that correction. Similarly in South Korea, for example, where rates are rising and yields are starting to follow. So it's broadly a global phenomenon. I mean, there are pockets where, somewhere like Japan, for example, rates are still rock bottom. But I think that the energy crisis, such as it is, I think makes Europe stand out in a more negative way than perhaps other parts of the world.
Okay, good. And Kathrin, you mentioned the difference in geographies. Maybe let's drill down a little bit into that. So what are you seeing there? Will some geographies be more attractive than others? What are your criteria for that? How do you see those?
Well, I think there's a strong tendency towards, let's say, more differentiation in terms of diversification and also geographies again. So I would think that, the world becomes more heterogeneous, and so if you find yourself in a situation where you can you have more local programs to fight with, that's probably easier, and there might be a tendency of those markets evolve earlier out of the, let's say, uncertainty and difficult situation than others. But always, I guess, we always have to bear in mind that when it comes on that this is macroeconomics and this is theory, but when it comes to transactions and the real life, the size of the market, liquidity, transparency, always matter, and we always have to bear that in mind. And and this is something which is always needs to be put into account as well. So I think we still can talk about tendency, but I would not say capital would go this way or this way.
Okay, good. And Nick, you mentioned there, you talked about the inflation side of it, of course, and whether or not it can be viewed as an inflation hedge, and I thought that about the fact that it's a long-term one was interesting. You also mentioned slightly the capital, the difference in currency, particularly for the US. We obviously saw the pound dropping heavily last week and beginning to recover a little bit, but at very comparatively very low levels to the dollar. How much of that is, I suppose, how much are some of the capital tending to hedge that, or is there some capital that doesn't hedge that? Because I've heard that, from a US capital perspective, the UK and Europe is on sale at the moment. But does that actually mean that's going to lead to, I suppose, to more capital focused on Europe?
Yeah, I mean, at one level, yes, it is on sale. I mean, sterling, even though it's bounced back to where it was before the latest shenanigans from the UK government, it's still down 15% on the year. So from an American investor's point of view, yes, that looks great. On the other hand, we all know in the January sales, it's quite dangerous to go into a shop and see a great big discount if you don't actually think, hold on a minute, you still need to look at the underlying value of what you're buying. I think for people who are looking at the UK or Europe, they like a particular sector or particular market and they think that there is value there, then you've got the double advantage that you can go in and selectively, if the right assets come up, and there's no question we are going to see assets coming to the market as people look to refinance, open-ended funds, other investors having to reweight, we're going to see assets coming to the market. If you're a US investor looking, you can get that with the added advantage of it being 15% cheaper than it would have been, this time last year. You still need to be careful. Looking back the other way, if you're looking to go into the US at the moment, but you are required to hedge your currency exposure, hedging sterling or the euro against the dollar is expensive now and is probably going to get more expensive. So that's going to be a bit of a headwind for money moving in that direction, even though I kind of agree that inherently from a fundamentals point of view, those markets might look attractive.
And there's go ahead.
No, I was just going to add to that, and I think, Nick, I've seen some numbers that there was more non-regional money coming into London than there was in the whole of the US in the first half of this year.
Yeah.
Because of the strength of the dollar, principally. You know, that deters that movement of capital that would otherwise normally happen. I think in terms of when we're looking across the globe, I think it's all relative, and I think people are looking for pockets of growth and areas and sectors that are going to provide relative robust returns and where you can drive value. But I mean, we say that Asia is a growth market, but one of the things we're picking up right now is that actually, though, investors are very cautious around China.
Absolutely.
And so you can't. And probably to Kathrin's point, it's really country by country, market by market, and when everything is moving around like this, it's quite difficult to pin things down in a generalist way and say, right, we're going to just do this.
That's interesting, that point about China as well. I mean, there's been a lot of discussion in the logistics ones that we've just been running around friendshoring, whereas that discussion was about nearshoring. If I think back to last year, friendshoring was brought up at the EPRA conference when the ex-head of NATO was just talking that is something for the real estate market that they're really going to have to consider, is where are they aligned, because that will be a question, a geopolitical question that will come up for people. So do we think, I mean, I don't know, Tom, whether you're seeing any changes in terms of investment flows into China, crossover flows, whether that's already beginning to slow. Are people looking at that as an issue?
Well, the Chinese, I showed some slides earlier. The Chinese market's been very slow this year, but that's of no surprise given the nature of the lockdowns. Shanghai and various other of the most important industrial hubs in China have been under extended lockdown, so this has made deal making virtually impossible. So yes, flows of money into China have slowed very, very sharply. I mean, there was an international presence there, but it's not anyway the same as you might see in Japan or somewhere like that. So it's been growing, and certainly money coming out of China, that's been slow for a long time because of the capital controls that were put on by the Chinese government back in sort of, it's been 2017, 2018. Where Chinese buyers were big acquirers of Manhattan office blocks, and that was all, they put a stop to that. So seen a little money coming out of Hong Kong. And so actually to your point about the currency, one thing I was going to say was after the Brexit vote in 2016, when the pound devalued then against the dollar, you saw high net worth capital coming out of Hong Kong and acquiring some very large London office towers. So that kind of equity rich, maybe more trophy driven investor, you might see them come into the market if there's opportunities. I think we're sort of TBC.
Okay, and are you already beginning to see some of that, Ryan, or not, in terms of the London markets? More of a focus on all equity, more of a focus on high net worth?
It depends, really. I mean, most of our clients are family offices or institutional investors. So, as Tom just said, some of them are trophy assets. They're quite happy to get their capital out of local country and protect their wealth through investment in what was historically seen as a stable UK. Maybe not so now at the moment, but for us, that is what we're seeing. So there's been a focus, Hong Kong, Singapore, Middle East, and a bit of North America as well, with also a move to private equity coming into the market more and more.
Okay, that's interesting to see. I wanted to pick up as well, ESG has been a big topic here. How's that influencing capital flows? I mean, so for example, we've had people saying that, BREEAM very good is no longer very good at all and not acceptable. And that people are then beginning to look really at, really top class sustainable assets, and that's a key element. Is that also the case for, is that where you're seeing the capital heading towards if we look at the types of product that people are looking for? Anybody can pick that up.
Well, I guess what we see is there is no prime without ESG, so it doesn't matter, where the capital goes. The perception of the market is, and the expectation is that you need to have an ESG, positive related asset. Otherwise, there would, people would not be interested in, paying high prices, and so they would not buy it right now.
Yeah, I mean, I agree with Kathrin. I think it's binary.
Yep.
I think you've talked about a prime asset now. If it doesn't have very strong ESG credentials, or at least a pathway to getting to those credentials, then it's just not going to attract the core capital. And I think so then you end up with a two-stream market, but which I also think actually drives that transition. I think that, not just through core capital, but also, you have the value add people in the market that are creating those core buildings. They're going to be getting really behind this agenda now as well, because their business plan depends on an exit to the corest capital.
We're seeing similar sentiment in terms of there are regulations potentially coming in future, in 5 years' time. If you're not thinking about it, you're going to be behind the curve. But also the return on investment, is it shorter now, and is it worthwhile making that investment to be ahead of your competitors? Certainly in the hotel and apartment space, they're thinking about that at the moment.
And are we seeing sort of transition funds coming out? Because you would have thought that ought to be a big opportunity, given the amount of, what will be brown space versus green space. I don't know if you want to pick that up, Nick.
Well, I think what's interesting in the current environment is that the atmosphere in the capital markets is slightly different to the occupier markets. Occupier demand is actually still holding up in many markets quite well, particularly at that top end of the market. And there, the tenants who pay the rent are the ones, they're voting. And they're absolutely voting and saying, even in the US, where ESG and sustainability haven't been as prominent as they have here in Europe, now top quality big tenants are absolutely demanding top quality assets. The challenge is that from a fundamentals point of view, now is exactly the time, both from a legislation point of view and because of that tenant demand, that you'd want to be going in, picking up those well-located but underperforming assets that need the upgrade and the improvement. The challenge is that the financing, the skills, actually finding people who will quote you to do the work and then hold that quote for any length of time is really, really difficult. So making the numbers work on those at the moment, it's very cost effective from a long-term point of view, but right now, putting the financing, putting the package together is going to be very difficult. But I think the asset prices in that sector are going to fall quicker than in other areas to reflect that. We'll see a real bifurcation in the market, and at the right time and the right price. That's absolutely going to be something that we are, yes, seeing specialist funds and general investors looking to target.
Sorry, I was just going to say you're seeing definitely a preference for quality coming out in our transaction volume numbers in the office market. I don't think now's not a good time to be holding secondary or tertiary offices if you don't have the capital to invest in them, because demand from the occupiers is falling away, I think, for those buildings.
Okay, good. I'm going to come for questions, so if you've got questions, think of them now, and I'll come to you in a second with them. But just in terms of the sectors, and I'm going to cover off something quite quickly here, which is, what are the sectors that are, I guess, the more resilient? What are the ones that global capital is looking at? And I suppose, how much of a challenge is it to raise capital either for those at the moment, but also specifically for others? So a lot wrapped up in that. Let's start with you, Stephen.
So I have a stab at that. I mean, I think offices, it's by far the largest traded sector annually, and it will continue to attract capital. I think Kathrin said that, where there is that that liquidity, that is a self-fulfilling piece that brings more capital in. So that liquidity and the size of the sector will keep drawing people to offices. They're being much more discerning. Secondary offices, much more challenging. Prime, yes, it's more expensive, but we've seen, grade A vacancy in offices plummet, and I think it's still very, very low. And what's happening now is also reducing the supply coming in, so that won't change. So I think core offices will remain a good place to put capital. We've been talking about operational assets, operational real estate, which covers a multitude of things, but hospitality and some of the living and the adjacency living sectors, but also I guess any asset that's amenity heavy. Arguably offices are becoming more amenity heavy. But I think that, we've been talking about that because that's been a place and an area where you can drive performance. That's also coming back to being able to protecting costs now as well. So having that operational expertise becomes really important as a manager and where you put money.
Well, I guess from the institutional perspective, people look at it from they want to get rid of the uncertainty. So any real estate which provides you with a protected cash flow, whatever sense that might be, is something people are looking at the moment. So it could be let's say they would stay in a market where yields are, tendency-wise rather low, then they would go to more the niche parts of the world, something like senior living or so they would still benefit from the, let's say, established market and everything we've been talking about. Or you might also look at it from a perspective, say, talking about operational real estate, that they would go for a cash flow which is less related to, let's say, consumer confidence. So looking at it from a, let's say, more broader perspective, this is something where we see the tendencies going to.
Okay, good. Does anybody have a question, by the way? If so, I'm going to, by the end of this sentence, I will have stopped and moved back to my last one. Great, very good. So let's just, because we are going to have an investors' lunch afterwards, Nick, aren't we, kindly hosted by Avison Jung, so do please stay and join us for that. But let's just pick up on, let's be positive about the opportunities part of it. So what do we see as the opportunities? Plainly, there's always buyers and sellers in every market. So where do we think those buyers and sellers might be looking? Where are the opportunities? We're going to start with you, Tom, because you were smiling, suggesting you were ready. Excellent. And then we'll move down that way. So Tom,
I've got the easy option here. I can go first. Okay. I mean, real estate's cyclical, and that goes back hundreds of years. So we're always at a point in the cycle, and we seem to be at an inflection point at the moment. And so these inflection points throw up opportunities. You get mispricing. Price discovery at the moment is tricky because buyers and sellers have moved further apart. There's lots of uncertainty. So I think there will be opportunities when assets are brought onto the market or forced to the market, either through fund, assets because of closed-end funds terminating, or because of refinancing difficulties, and those moments will throw up opportunities to access stock at a discount to prior levels. That might be in the the industrial sector, it might be the office, but it might be in apartment. But I think the opportunity will be there for those who are kind of nimble on their feet over the next 12 to 18 months to take advantage of some of that dislocation.
I'm going to agree and disagree. I think that there will be some very clever people that are able to pick up those assets at the bottom of the inflection point. I think really the opportunities are going to be, looking medium term, anything that has a macro trend behind it rather than a cyclical piece. I think you've got to be very smart to catch that cyclical piece at exactly the right time. So I think that where we'll be looking towards the bigger trends that generally aren't changing and aren't subject to some of these short-term anyway cyclical movements.
I keep it simple, stupid. I would think in a situation of uncertainty, there's always a flight into quality. So anything which provides you with really good quality in terms of whether it be location or ESG or whatever, that's where the opportunity is. And if you get that for a decent, pricing, that's the opportunity.
Okay, great, right.
I agree with everything there. For me, I think it's about innovation. Other sectors have had to evolve over the last 2 years. Real estate historically has been quite maybe slow in encouraging innovation. Maybe now's the time to take on board some of the stuff we talked about with ESG. Thinking about future retirement living in the UK is going to be a big thing. We've got an ageing population. How's that going to work in future, especially with energy costs unlikely to come down anytime soon? So for me, it's innovation.
Okay, great. Nick?
Yeah, I mean, structural stories are obviously going to give greater protection. I think the The concern is where do you price that if we are, as I believe, moving into an environment over the medium term where interest rates are structurally going to be 200 basis points higher than we've been used to, and that's going to be pretty crowded space. I slightly disagree with Stephen. I think the opportunity is not necessarily pure pricing, but there will be assets coming to the market in the current environment that wouldn't have done. The other thing that happens is, we're hearing it all over the place, people are very risk averse. The pricing on risk is therefore blowing out. So therefore, if you can identify the right assets, the right strategy, it's going to be a brilliant time to be able to pick those up. You've got to be brave and you've got to know what you're doing, and there's absolutely risk there, but you are probably being rewarded better for taking that risk now than you have almost at any stage in the last 10 years, and that's got to be exciting.
Okay, great.